What do retirement investors actually own? Most people believe their 401k, IRA, or brokerage account balance represents their stocks, their bonds, or their mutual funds. That perception feels intuitive, but legally, it is not accurate. In most investment accounts, what investors hold is not legal ownership. It is a beneficial interest. A beneficial interest means you are entitled to the economic benefits of an asset, but you are not the legal owner of the asset itself. You benefit from it. Someone else legally owns and controls it. When you own stocks or bonds through a 401k, an IRA, or a brokerage account, you typically hold a beneficial interest. That means you participate in gains, dividends, and losses. You do not hold securities in your own name, and you cannot point to specific shares and say, "Those are mine." Your rights are contractual, not property-based. With beneficial interest, legal title is held upstream through custodians and clearing systems. Your claim is not a property right to a specific asset. It is a contractual claim within a system. In the U.S. securities system, assets are held inside the DTCC system. Legal title is registered to Seed and Commerce, the centralized nominee. Your 401k, IRA, or brokerage account holds a beneficial interest. You hold a contractual claim on the plan or intermediary. In normal markets, everything works smoothly. Trades settle, statements reconcile, income appears on schedule. But in stressed or broken markets, legal structure matters. Legally, inside the securities intermediation system, protection flows by statutory priority, not by account balance. At the top, derivatives and repo counterparties, clearinghouses, and secured lenders. Below them, broker-dealers, custodians, and retirement plans. And at the bottom, individual investors and plan participants. In a crisis, 401k, participants and brokerage account holders are not asset owners, not secured creditors, and not priority claimants. They absorb losses after the system protects itself. This fragility does not require fraud or misconduct. It arises from netting, rehypothecation, collateral substitution, and margin calls. These are standard features of modern finance. Rehypothecation is the practice where banks and brokers reuse investor assets as collateral for their own purposes. It increases liquidity and efficiency, but it also means investors do not control how their collateral is reused. Netting allows institutions to collapse thousands of obligations into a single net payment. Individual assets are not returned to original owners. Claims are satisfied by priority, not by tracing specific securities. This brings us to a critical distinction. Assets held in the securities intermediation structure are pooled and netted. Properly structured insurance contracts operate differently. Properly structured income contracts are not pooled securities or margin collateral. They create a direct contractual right to payment, not a residual claim on system assets. This is why pensions survived when markets crashed. Social Security pays regardless of asset prices. Insurance-based income is legally senior to investors. The real vulnerability in retirement is not volatility. It is timing risk inside a priority-based system. 401ks solve accumulation, but not income certainty. Restoring a defined benefit-style outcome is structural risk management. Guaranteed income converts market exposure into senior contractual cash flow rights. If you truly own an asset, creditors of intermediaries cannot touch it. A directly owned insurance contract is not on a broker's balance sheet and cannot satisfy their debts. Legal structure diversification is the practice of separating assets by legal treatment. By combining market assets with an income bucket, investors reduce system risk. Everyone needs some assets outside the system. Legal structure diversification. It's the missing piece of retirement strategy.